Is the market poised for a sell-off, or is it more likely to head higher, particularly after the election on Saturday and in the wake of earnings season? For more, I'm joined by Geoff Wilson, the founder of Wilson Asset Management. Geoff, tough question.
Oh,
hello, mate. How are you?
Very good.
We have sort of talked before we come on
That's
here,
right.
so
yes.
I feel as though I'm in touch with you
Yes.
again on the
Yes.
same vibration.
Yes.
Mate, do you think this market's poised to go up or down?
Let's look at a couple of the facts. The Australian market over the last month's up about 2.7%. That's your Lord's accum.
Yep.
And the US market's down about 6.5%.
Great to see, isn't it?
Yeah, so we've outperformed by little over 9%, which is phenomenal outperformance. Now, why have we outperformed? There's no doubt our weaker currency is good for us.
Yep.
And there's no doubt that there's no doubt with the election and I suppose the hiatus in the consumer doing anything from when it was called by Gillard in January, and as the odds tightened on the Libs winning, then we've probably had that positive impact already factored into the market.
Yep.
Also, once the election's over this Saturday, it appears highly likely, and we believe that lower interest rates, lower Aussie dollar, we'll start seeing the benefits of those in terms of consumer activity. So we expect the last quarter to be good. The tough thing I'm trying to work out at the moment is, has the market already run in anticipation of that?
Yeah.
And that may well be the case. We had the market up, a little over 20% for the year to June, and we've done, sort of close to 8%. So we've done 30% in say, 14 and a bit months. So if it has a bit of a breather, wouldn't be at all surprised. There's no doubt, and the market tends to move 6 to 9 months ahead of the economy. So what the market's telling us is the economy will be better in 6 to 9 months' time, and that's what it appears it will be better in 6 to 9 months' time. And really, it just probably depends on how much better it is.
Yep. Okay, that's the economy, and what you said then was neatly and succinctly put together by me last night and over the last few. So we are on a unity ticket.
Yes.
I believe 2014 will be better than 2013.
Yes.
But for my viewers at home, the next thing is, okay, the economy is going to be better.
Yes.
Do we expect, or does Geoffrey Wilson expect, the stock market then to keep rising over that period of time?
Yes, I do, but we've had a lot of the rise already. We've had 30% of it. Yeah.
But we're ungrateful. We want more.
And we will get more. And one of the, like Andrew McCauley, he's he looks at statistics. He's done some great work on statistics. He's a broker. Pay a lot of attention to his work. This is the fact you've got to remember. Since 1900, every 10-year period, so January 1900 to January 1910, February 1900 to February 1910, there's been a little over 1,260 of those 10-year events.
So you're picking out every 10-year based on months?
On months, yeah. The market has always been up 10 years later. So if we say, where will the market be? 1st of November 2007 was the top of the market, a little over 6,800. Will it be 1st of November 2017? It'll be above 6,800. So that's still another 30-odd% we need to get to, and we've got 4 years to get there. So, it could easily, it won't necessarily do it in a straight line. There'll be ups and downs, but we're heading in that positive direction.
So when I make this generalisation, I've made it a few times, and I said I haven't got the historical support for it. When I say that a stock market, I use the word generally, will pass the old high before it crashes again.
Yes.
Is that a fair generalisation?
Yeah, it is, and particularly now that we've effectively got 4 years to get there. If we had a crash now,
it'd be quite historically
unusual. it would be like for the market to get back up to that high would be a phenomenal performance for the market.
Yeah. Okay. So that's good. You're making us happy here. So being in the market is still the place to be, at least for the next 2 years.
Yes.
If you want to get out early, you might get out in the third year and go on a term deposit.
Yes.
All right. Okay.
And everyone's worried, and as we all know, bull markets, they do climb a wall of worry. So everyone throws up. I think in your intro, someone's talking about recession. There's this and that. and we always get that.
Yeah, but we're not really in. If we use Templeton's idea,
yes.
we're kind of still in the scepticism stage, aren't we?
Yes, definitely.
We haven't got into the next stage after scepticism is. Euphoria is the last one.
Yeah, I'm not sure. All
optimism.
I know is,
the optimistic stage, and then you get into euphoria, and that's when you get your butt kicked if you're staying too long.
Exactly. Yeah.
So, but I've been arguing with, like for example, with my clients and also in my newsletter, is that we've done the easy bit. Like in March 2009, when on this show we're saying, I think you should be in the market. You could have bought an ETF and just slip, and the market goes up on the index. Or then we went to dividends, and the dividend portfolio, I think we did 22% on our portfolio. We put out here.
Great result.
But that was too easy.
And that's probably not value into franking as well.
No, that's right. Yeah. So there was just great companies. But now I've been saying, I think we have to be stock pickers.
Yes.
And that's why I've been looking at people like you and Roger and people who actually, that's your game. You pick stocks.
Yes.
Do you think this is a perfect time for guys like you?
Oh, yeah. And we saw it in the reporting season. Everyone was expecting a poor reporting season. It was a poor reporting season. The downgrades to upgrades were a lot. I think it was nearly 2 for 1 downgrades to upgrades. But the market didn't fall. The market actually rose because the market, everyone was expecting it to be that bad, if not worse. And over that period, there's some stocks that came out with some really good results. One, Hills Industries, they announced some acquisitions today. We're very keen on that. Slater and Gordon's another one. One of our holdings that we've been a shareholder for a long time, and I was just talking to when I was driving out here, John Abernathy. He's the managing director of Climb Investment Management, CIW. They've increased they're a fund manager, like a baby Magellan, I see it, and they've increased their funds by about 60 or 70% over the last 12 months, and they're the guys that were exposed to Macmillan Shakespeare, didn't lose their nerve when the FBT thing came, saw the share price halve. You see it now, it's up at $13 odd, and it'll probably go a little bit higher. And they bought more when it got down to that $7 level. So, I mean, they're a good fund manager. You just got to look through. You've got to be selective in terms of the stocks you're looking at.
And can the large collection of smaller cap companies, and these are they're good sized companies, but they're smaller cap compared to the biggies that we often talk about. Can they collectively keep the index going along as well? Because we often think that it's always the biggies, it's BHP, but obviously, if we think we're going to go past that 6,800 mark in 4 years' time,
definitely
the little guys are going to have to.
That's right. The first leg is the big guys, and then everyone looks around. Where's the value underneath that? Looking for the smaller guys. I mean, they actually. I suppose the tough thing is, the small cap industrials have had a very good run. Yeah, they have. Recently. Okay. I know last time or the time before you were talking about you were buying a mining services company. Everyone hated it. We're still that's
still buying it.
I mean, since then we
can't name it still.
Well, no, because we haven't finished. Since then we bought some RCR and they've done very well.
Is Monadelphous a company that's back on the radar screen? Because it was belted up.
It is, but it's just. I mean, we've got to find another catalyst. We bought some Transfield. Chris Dodd, who's our Chief Investment Officer, he went to the briefing the other day. There were 40-odd institutions, and they really look as though they're starting to get their act together. The tough thing is...
Not before time.
Well, exactly. That's right. I mean, the tough thing is, the share price in that. It shows you how quickly the share price can move. I think it was 90 cents a week or two ago, and it's around $1.30 odd now. So
it's a big jump.
Yeah, some big moves.
Okay. Now, I asked you to look at a company called Xero.
Yes.
And the reason why I did, I actually emceed their conference last Thursday and Friday. And I was staggered because they're made up of bookkeepers and accountants. They're the clients or partners in a sense.
Yes.
And they've dropped companies like MYOB and Quicken, and Reckon was the local division for Reckon. And you're a great supporter of Reckon.
Been a shareholder. We had been a shareholder.
Made a lot of good money out of it.
Yeah, for about a decade. Yes.
And what I was fascinated about these guys is that the industry seems to love them, and these people are dumping MYOB, which used to be like the monster in this market. And so I started to look at their share price, and even the day when I was emceeing the conference, it went up $1, and it's gone up the last few days as well. Yeah. So I said, tell me what... And I think a lot of people were saying they thought that the market had really priced in their potential. Yes. What do you see in a company like Xero?
Yeah. The tough thing about Xero is it's valued at a little under $2 billion, I think $1.8 billion.
That's the market cap. That's what the market's valued.
Yeah, and it doesn't make any money.
Yeah.
Now, they're gaining market share from MYOB and Quicken, and Quicken's in Australia is owned by Reckon.
Yep.
So you really don't want to be owners of, well, MYOB's not listed anymore, but you don't want to be owners of Reckon. You know, they're going to find it very difficult.
Yeah.
And all the anecdotal information we've been getting from people we know in the accounting game is they've got a fantastic product, Xero.
Yeah.
They're looking to go into the US.
Yeah.
I think Intuit's got something like 98% of the market
Extraordinary, isn't
over there. So,
and Intuit, by the way, is Reckon's product, QuickBooks.
Exactly. Yeah, it's the Quicken product.
Yeah.
But you think when someone's got 98%, there's potential to chip away. The tough thing is, I wouldn't at this point in time want to own anyone in the space because the one with the greatest potential, which looks like Xero, is really valued significantly in excess of any potential earnings.
It's very much on blue sky. Now, the reason why I wanted to bring them up was, for the last 3 or 4 years, I would bring up great companies like Seek and REA. And could they have been in the same sort of situation as Xero, that you couldn't buy them on PEs and that sort of stuff?
Yep.
But they keep defying.
And they are. And the question is, it's all about risk reward.
Yeah.
To me, when do you buy those companies? You really, it's just a bit early for Xero to buy at the moment. Even though you might make 100% on your money from here, it's how much risk are you taking? They're not making any money. Wait for them to start making some good money, and then they can still be on a high-ish PE, but they're making good money, and then you buy them.
So the lucky people, the smarties, have got in.
Yes.
Because they were about $4 in November. So there's been a nice big run up. So you're saying wait till they start making some real profits and some real headways, and then they could really spike. Well, there's been talk of listing on the Nasdaq, and I think they're a $25 company, but that's still.
Well, see, you're just taking an enormous amount of risk.
Yeah.
If they just focus on making money, they'd probably make money at the moment because they're investing in development and growth. But if something goes wrong, then there's no real fundamentals. How do you value a company that's not making much money?
The market can overvalue and they can sell you off pretty quickly as well.
That's right.
All right, mate, fantastic. It's the kind of analysis I wanted you to share with us, because a lot of people get excited when companies go ahead, but on the same point, people don't want to think, oh, is this going to be the next Seek or the next realestate.com.au?
And it could be, but where do you want to get in? You can take the high risk and get in now or over this period, or you can take a lower risk strategy. And still, if you'd bought those companies like Seek or realestate.com. I mean, there are other companies, travel.com, where are they now? Gone. The ones that didn't make it.
And also, the bottom line is this. If in 3 years' time a GFC happens again, that company will be smashed, but it will be a real business that you can invest in at low prices. And that's what you're always on the lookout for.
No,
you're such a smart guy.
No, you're the good one. You've been bullish. You've been bullish for a long time, and you've been 100% right. Well done.
Mate, thanks for coming on the program, and thanks for praising me. I really find it difficult to cop praise, but that's great. That's Geoff Wilson. Thanks for coming on the program, Geoff.